I'm staring at my friend's text message, and it says, I just got declined for a $500 loan to cover my rent, and I have no idea how I'm going to pay my bills this month. And I'm thinking, this could be any of us, right? I mean, we've all been there, living paycheck to paycheck, with no safety net, and just one unexpected expense away from a financial crisis. My friend's situation is a perfect example of how quickly things can go wrong, and it's a stark reminder that we need to take control of our finances, starting with the basics, like investing. Now, I know what you're thinking. Investing sounds like something only rich people do, or something that requires a lot of money to get started. But what if I told you that you can start investing with just $500? It's true, and I'm going to walk you through the exact first 3 steps to get started. First, you need to understand that investing is not just about making money, it's about building wealth over time. And the sooner you start, the better. So, let's make a promise to ourselves. By the end of this video, you'll know exactly how to start investing with $500, and you'll be one step closer to achieving financial freedom. I want to share a story with you. My cousin, who's a single mom, was struggling to make ends meet. She was working 2 jobs and still couldn't afford to save anything. But then she discovered the power of investing. She started with just $500 and began to learn about index funds and ETFs. Fast forward a year, and she's now investing $500 every month and has built a small portfolio that's generating passive income. She's not a financial expert, but she's taking control of her finances, and that's what we're going to do too. Here's a small insight to get us started. Did you know that investing just $500 a month can add up to over $100,000 in just 10 years, assuming a 7% annual return? That's the power of compound interest, and it's something that we can all tap into, regardless of our income or financial situation. Now, let's dive into the first step. Step 1. Choose a brokerage account. You can't start investing without a brokerage account. It's like having a bank account, but for investments. There are many options out there, but some popular ones include Robinhood, Fidelity, and Vanguard. When choosing a brokerage account, consider the fees, investment options, and user experience. You want something that's easy to use and won't eat into your investments with high fees. For example, Robinhood offers commission-free trading, which means you can buy and sell investments without paying any fees. Now, I know some of you might be thinking, but I don't know anything about investing. Don't worry, we'll get to that in the next steps. Just remember, the key is to start small and be consistent. Pattern interrupt. Did you know that 60% of Americans can't cover a $1,000 emergency expense? That's a staggering statistic, and it highlights the importance of building an emergency fund and starting to invest for the future. Let's move on to the next step. Step 2. Learn about index funds and ETFs. Index funds and ETFs are a great way to start investing, especially if you're new to the game. They allow you to diversify your portfolio by investing in a broad range of assets, such as stocks or bonds. Think of it like a basket that holds many different types of investments. This way, you're not putting all your eggs in one basket, and you're spreading out the risk. For example, the S&P 500 index fund tracks the performance of the 500 largest companies in the U.S., so by investing in this fund, you're essentially investing in a small piece of all those companies. Now, I want to ask you a question. What's the biggest debt you're currently carrying? Is it credit card debt, student loans, or something else? Share your answer in the comments below, and let's work together to pay off that debt and start building wealth. Let's move on to the next step. Step 3. Set up a regular investment schedule. This is where the magic happens. Once you've chosen your brokerage account and learned about index funds and ETFs, it's time to set up a regular investment schedule. This means committing to invest a certain amount of money at regular intervals, such as $500 a month. You can set up automatic transfers from your bank account to your brokerage account, so you don't even have to think about it. The key is to be consistent and patient. Investing is a long-term game, and it's not about getting rich quick. It's about building wealth over time, and that requires discipline and persistence. For example, let's say you invest $500 a month for 10 years, and your investments earn an average annual return of 7%. After 10 years, you'll have invested a total of $60,000, but your portfolio will be worth over $100,000. That's the power of compound interest, and it's something that we can all tap into. If that just clicked for you, hit like. It tells me to keep making this type of content. And if you know someone who's struggling to get started with investing, send them this video. We're all in this together, and we can support each other on our journey to financial freedom. Before we go, I want to tease our next video, which is all about how to maximize your returns on investment using tax-advantaged accounts. We'll be diving into the world of Roth IRAs, 401(k)s, and HSAs, and exploring how to use these accounts to minimize your tax liability and build wealth faster. It's going to be a game changer, so make sure to subscribe and hit the notification bell so you don't miss it. Thanks for watching, and we'll see you in the next video. Now, let's take a closer look at how to optimize your investment strategy. For instance, did you know that investing in a tax-efficient manner can save you thousands of dollars in taxes over the long term? It's true, and it's something that we can all benefit from. Let's consider an example. If you invest $500 a month for 20 years, and your investments earn an average annual return of 8%, you'll have invested a total of $120,000. But, if you're in a 24% tax bracket, you could be paying up to $30,000 in taxes on your investment gains. That's a significant amount of money, but what if I told you that there are ways to minimize those taxes? One way to do this is by using tax loss harvesting. This strategy involves selling investments that have declined in value to offset gains from other investments. For example, let's say you invested $1,000 in a stock that's now worth $800. You can sell that stock and use the loss to offset gains from other investments, reducing your tax liability. It's a powerful strategy, and it's something that we'll be exploring in more detail in our next video. Another way to optimize your investment strategy is by taking advantage of dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market's performance. For instance, if you invest $500 a month, you'll be buying more shares when the market is low and fewer shares when the market is high. This can help you smooth out market fluctuations and reduce your overall investment risk. Now, I want to share a real-life example of how dollar-cost averaging can work in your favor. Let's say you invest $500 a month for 10 years, and the market returns an average of 7% per year. If you invest at the beginning of each month, you'll be buying shares at different prices throughout the year. But, if you use dollar-cost averaging, you'll be investing a fixed amount of money at regular intervals, regardless of the market's performance. This can help you reduce your overall investment risk and increase your potential returns over the long term. Pattern interrupt. Did you know that the wealthiest 1% of Americans hold over 40% of the country's wealth? That's a staggering statistic, and it highlights the importance of building wealth through investing. But, here's the thing, you don't have to be wealthy to start investing. You can start with just $500 and build your way up over time. Let's talk about the power of patience in investing. It's easy to get caught up in the excitement of investing and expect quick returns, but the truth is, investing is a long-term game. It's about building wealth over time, not getting rich quick. For example, if you invest $500 a month for 20 years, and your investments earn an average annual return of 8%, you'll have invested a total of $120,000. But, if you're patient and let your investments compound over time, you could have a portfolio worth over $250,000. That's the power of patience, and it's something that we can all benefit from. To illustrate this point, let's consider a study by Fidelity Investments, which found that investors who stayed in the market during the 2008 financial crisis and didn't make any changes to their portfolios ended up with higher returns over the long term than those who tried to time the market. This highlights the importance of having a long-term perspective and avoiding emotional decisions based on short-term market fluctuations. Now, I want to ask you a question. What's the one thing you're going to do today to take control of your finances and start building wealth? Is it going to be opening a brokerage account, learning about index funds and ETFs, or setting up a regular investment schedule? Whatever it is, share your answer in the comments below, and let's work together to achieve financial freedom. Before we go, I want to leave you with a quote from Warren Buffett. 1.